Hi traders, Stan here. In the previous video I have shared with you some technological tips of how to become a semi-automatic trader. In this video I'll focus more on the trading strategies. The first class is trend following strategies or momentum strategies, and the second class is mean reversion strategies. We'll go through examples from real life experience, and I will share with you what to expect, what is adequate, what is the average performance gain in terms of P&L in percentage, and so on and so forth. Let's go. Trend following strategies are very old. Traders have been using them more than 100 years ago when Charles Dow had invented technical analysis, and people were following trends back then on the stock market mainly. Then people were making trend following strategies in commodity markets. There is widely known experiment called totals, which was brought by Richard Dennis, the Prince of the Pits, and he described this experiment in the book. They have been using commodity futures, employing simple trend following techniques and strategies, and they made some money, of course. The idea behind trend following strategies is very simple. It's cut the losses short and let the profits run. That is possible because markets generate trends. Whether we like it or not, it completely contradicts the random walk theory and the notion that the markets are random. They are not random because there are trends, and trend following strategies employ this feature of the markets. Usually stops for trend following strategies are quite tight. They're relatively small in comparison to profits, and the asymmetry between profits and losses sometimes might be very, very big. Let's say your profitable trade might exceed your losing trade 30, 40 times, sometimes 50 times and more. But of course, nothing comes without the price in the markets. There is no free lunch. When you have tight stop losses, sometimes there are extended periods of plateaus or drawdowns when you employ trend following strategies. Imagine that there are no trends for extended period of time. Sometimes that happens. Market may be locked in a consolidation for a long, long time, and you still continue trading, placing trades with small stops, and those small stops are executed most of the time, and you might end up with 90% of your trades being losses. And as a result, you have the plateau or the drawdown being accumulated on the account. Let me show you the practical example of one of my strategies. It is a trend following strategy, which I use for crypto futures. So that's the performance of this year, the year of 2022. The overall performance of the strategy was quite notable. It's 200% annual performance, but drawdowns are also pretty deep, so they sometimes achieve 50%. Well, that's okay for this kind of risk to reward ratio. And for some people it looks like a lot, but for the risk I take, that's pretty okay. So I don't hold all of my funds in this strategy. I hold only the money which I use in this strategy. So for me, 50% drawdown is not a catastrophe at all. Let's take a closer look to the performance. As you can see, profits are almost 3 times greater than losing trades. That gives the strategy the edge. There are also spectacular trades which exceed losses for 25 or maybe 30 times. And there are big trades which actually drive the equity curve or drive the account very quickly to the new high. The biggest drawdown though was accumulated in September and October when Bitcoin started to lock in a very, very narrow range. But that's not only the loss of volatility which was accountable for this loss. Also some features of the strategy made it lose. The market has become rotational with no edge, so there was the tremendous amount of rotation in comparison to existence of any trends. And that's why strategies started to give money back to the market. The accumulation of losses was quick, so at some point in time I had to freeze the strategy, to apply dynamic risk management, and to shift in the survival mode. Nevertheless, by the end of the year, the result of the strategy was still positive, so it still generated 200% annual performance. That's positive, of course, but you see that there are extended plateaus and drawdowns. There is no silver bullet to completely eliminate drawdowns here. You can do your best to minimize them, and you can also do your best to maximize your gains, to expand your gains. So that's actually the silver bullet against those drawdowns. You are expected to earn more to offset those drawdowns. So that's the notion of trend following strategies. Let me show you another example, which I've taken from the collective2.com service. This is the example of a strategy which has pretty deep history, already more than 3 years. It's called SQQQ TQQQ swing trading strategy, run by professional money manager, and here's what we have. Then, as you remember, the market started to break as Federal Reserve had promised to raise the interest rate, and they did it in 2022. So the market has become choppy and sometimes bearish. So as a result, we see the plateau with drawdowns on this strategy. So you see that the performance was not as tidy, not as good looking as previously. So actually this is a trading range which is extended and it lasts for already 1 year. Not so good, huh? So with the overall performance of 60 something percent, the drawdown was as big as 50%, which looks as a catastrophe, or that looks as if the strategy is broken. But if this trader sticks to the plan and continues to follow the trend, eventually he will be able to create another leg for this strategy and to drive the strategy to the new high. So whether it's a bearish market or a bullish market, we never know what market exactly would there be, but if there would be any extended trend, this strategy will be able to generate profit. Another example is the equity curve of the strategy run by hedge fund Algo Capital. So they publish it on their website. So some money managers have master's degree in math, so they're pretty sophisticated people. But as you see, even they cannot avoid generating drawdowns and plateaus as the strategy develops. The performance for 5-year period starting from 2017 was spectacular and close to 1000%, but drawdowns are also quite deep, so sometimes they achieve 50%. But as you see, the shape is pretty similar to what we've seen on Collective 2 strategy, to what we've seen on my strategy. So you accumulate your profit quickly and you make pretty substantial profits, and then when the market breaks, you start generating either drawdowns or plateaus, so you turn into survivability mode. There is no silver bullet, so there are no strategies which actually capture money from the market all the time, and that's the drawback of a trend following strategy. You have to survive sometimes, and you have to switch in the survival mode, and sometimes that's tough for many people. Psychologically, it's very, very difficult to withstand such extended periods of drawdowns. Some people just start drifting to another style. They quit the strategy, they say, okay, I've lost money, so that's it, I'm switching to another strategy. But if you are patient enough, so if you stick to your plan, eventually you will catch another trend. That's the notion of trend following. You have to be patient, you have to withstand those plateaus and drawdowns, and if you can do that, eventually you will be rewarded with another leg, another period of accumulation of profits. Let's talk about entry points now. That varies upon trading instrument, but in overall, entry points don't matter that much in trend following trading, because the odds are so that you won't find a perfect entry for your trade, because if you have a heavy skew towards the negative expectancy for your trades, I mean, there are more stops than profits, well, one stop more, one stop less, so eventually you will be able to catch the wave in your direction. However, we know that overtrading is a big issue in trend following trading. So of course, trend following traders do their best to actually fine-tune their entries. So let's talk about that. The goal of a trend following trade is to try to jump in the move relatively early when it's just starting out. For example, the price was standing in some trading range or near the support, then it starts to move. So for a trend following trade, it's very important to try to jump in early. Otherwise, it will be difficult to join the trend later, because later the trend will be choppy, so it will go back and forth in trading ranges, and it will be relatively difficult to actually enter the position. So if you are entering early, so you have some kind of advantage. The trigger for the move might be either a breakout of some trading range, well, specifically narrow trading range, or the position of the price near some kind of support or resistance. When it's ready to take off and you are prepared for that and you are monitoring for the price in anticipation of the beginning of the move. So as for breakouts, it's relatively straightforward. The price was consolidating in a narrow trading range for maybe weeks, and then suddenly something happens and it comes closer to the border of the trading range, and the trader just takes the position, and if the trader is lucky enough, so the price takes off and the trader already has the position which he or she can manage. Another scenario is when price pulls back to some important resistance or support area and then reverses back and starts moving in the direction of the primary trend. That's more realistic in many cases because you are dealing already with the trend which is already happening. To fine-tune the entry, traders often search for some, specific patterns such as candlestick patterns, for example, engulfing patterns or similar. So they allow a trader to fine-tune the entry and to actually maximize the timing here. Because in that case, the probability starts skewing in the direction of a trader, and the stop loss may be relatively small. So, and if the price moves in the direction of the trend, so the profit-loss ratio might be quite substantial. How one can manage the position? For a losing position, that's relatively straightforward. If you got stopped out, so you just exit the position whatsoever and you wait for the next opportunity to appear. For winning positions, that's a different story. So if you already have some profit, so you need to manage that. Otherwise, you won't allow the profit to float freely on your account, right? Doesn't make any sense. What if the price comes back to your entry point and you gain nothing? Of course, we need to manage the position somehow. There are two ways to do that. For long positions, it's better to use trailing stops. We've done some tests and back tests, and they confirm this point of view. So when the market rises, it usually happens in a wave-like mode. It moves smoothly in many cases, and one can just move the trailing stop just after the price, moving it, below the dynamic support or some moving average, and it might happen unless the position is closed by the opposite move. For short positions, the situation is a little bit more complex. For many assets such as cryptos and stocks, volatility tends to rise when the market drops, meaning that at some point in time, buyers start taking control, they buy it back, and we see substantial pullbacks. So if you hold position with a trailing stop, so in many cases you will exit the position by the not so good price. In other words, as the position moves in your favor, you select several targets and you unload your positions partially whenever price comes to those targets. For example, if it comes to the first target, you unload 1/3 of your position. It comes to the second target, you unload another third of your position, and so on and so forth. So that would prevent you from pullbacks and shakeouts, which inevitably happen when the market moves down. The third or fourth part of your position may float in the market freely. According to my experience, some positions may become very profitable if you don't close it too early. For example, I was shorting Luna back in April 2022, and if I held it for 1 or 2 weeks more, so the profit might have become much greater than I have taken back then.